Hey everyone, welcome back to the channel. Today we're going to tackle a question that's been sort of swirling around in my head, probably in yours too. Is the party over for U.S. stocks? I mean, it feels like we've been riding this like epic bull market forever, right? Like just smashing record after record, champagne popping, confetti flying. But could this be like too good to last? That's what I kind of want to unpack with you today. The U.S. economy has been like flexing some serious muscle lately. We've got solid job growth. Retail sales are looking pretty good. And even the Atlanta Fed estimates that our GDP grew at a rate of like 3.4% in the third quarter. It doesn't exactly scream economic slowdown, does it? And all this good news has investors feeling, well, pretty hyped, right? The S&P 500, for example, has been on a tear, hitting 47, record closes this year alone. It even had a 6-week winning streak. That's the longest one since late last year. So Wall Street seems to be in like full-on celebration mode. But here's where things get really interesting. This incredible stock market performance.
Well, it might actually be fueled by a little slip up from the Federal Reserve. Remember that surprise interest rate cut a few months back, the one that was meant to prevent an economic slowdown? Yeah, it might have backfired a bit. Some analysts think this rate cut was like a tad too dovish, meaning the Fed might have made things a little too easy with monetary policy. And now we're seeing the consequences. The potential stock market melt up. Imagine everyone like rushing into the market at once, pushing prices up like a rocket. That's a melt up. And some folks think the Fed's rate cut might have, lit the fuse. But before you go all in on your investments thinking this party will last forever, hold on a sec. Not everyone's convinced that this can keep going. There's like a growing group of skeptics who believe that this level of market excitement, it's just not sustainable. They argue that investors have become a little too accustomed to those sweet double-digit gains year after year. They're saying a reality check is coming. One of these skeptics is Torsten Slope from Apollo Global Management.
He's a big believer in valuations as a predictor of future returns. And right now, well, those valuations are flashing some warning signs, like those flashing lights on a cop car. For instance, the, say, PE ratio, which is it's like a fancier PE ratio. It kind of smooths out the bumps in earnings over a few years. It's sitting pretty high, near 40. That's way above the historical average of 22 since 1940. And let's not forget, the S&P 500 has more than tripled in value over the past decade. Analyst David Kostin, well, he doesn't think the next decade will be nearly as generous to investors. He's predicting a much lower annual return for the S&P, somewhere around 3%, which would make it a pretty weak period for the market, historically speaking, that is. But maybe the most unsettling comparison, it comes from John Authers over at Bloomberg. He points out that the S&P is currently more expensive than it was right before the Great Crash of 1929. Yikes, right? Now, before you hit the panic button and sell all your stocks, remember that valuations aren't perfect predictors of like short-term market movements.
As Authers himself admits, an irrationally expensive market can always get more expensive. So while many Wall Street analysts are still feeling optimistic about the next 12 months, the long-term picture painted by these valuations, well, it's a lot less rosy. The message seems clear. Over the next decade or so, U.S. stocks might lag behind their international counterparts and even underperform compared to those trustee bonds. And it's not just, individual analysts sounding the alarm. Goldman Sachs, one of the biggest players on Wall Street, they've also voiced concerns about these, high valuations. Their argument, high valuations basically pull forward future returns, leaving less room for growth down the line. To understand their logic, we need to revisit that CPE ratio. By factoring in earnings over a full economic cycle, it gives us a more realistic view of a company's true worth. And when that ratio is as high as it is now, well, it suggests that a lot of that future growth potential has already been priced in. But here's the real kicker. The S&P 500's current forward price to earnings ratio, which measures its expected future earnings.
It's just under 22. Now, if history is any guide, that could mean we're looking at some pretty underwhelming returns over the next 3 years, potentially as low as 3% annually. So we've got this interesting tension building. On one hand, we've got this short-term excitement fueled by strong economic data and a dovish Fed. But on the other hand, we've got these long-term concerns about, historically high valuations and the potential for a significant market correction. It's kind of like showing up to a party that's been raging for hours. You might be tempted to jump right in, but you also might want to, take a moment to assess the situation, see how much everyone's had to drink, get a feel for the vibe. That's what we're doing here today, getting a feel for the market's vibe. And in the next part, I want to dive into some strategies for navigating this complex landscape. How do you decide whether to join the party or head home early? We'll talk about that and more. So stick around, and I'll see you in part 2. All right, so We talked about the markets, like current vibe, right?
This whole push and pull between short-term excitement and those, long-term concerns. So now let's get practical. Like, how do you actually navigate this landscape as an investor? How do you decide whether to join the party or, call it a night? Well, first things first, remember that investing isn't just about chasing those, like, flashy returns, right? It's about understanding the risks and making decisions that, match your financial goals and, importantly, your risk tolerance. It's like, think of it like this. You wouldn't climb Mount Everest without the right gear and preparation, right? Same goes for investing. You need the right tools and knowledge to tackle the market's ups and downs. One strategy that can help you, weather any potential storms is diversification. Don't put all your eggs in one basket, as the saying goes. Instead, you want to spread your investments across different asset classes. Why we're talking stocks, bonds, real estate, maybe even some, alternative investments like precious metals or even cryptocurrencies. Why diversification? Because it helps manage risk. If one asset class takes a hit, others can potentially soften the blow, right? It's like having a backup parachute just in case. So how do you diversify? Well, that depends on, your situation, your goals, and your comfort level with risk. Maybe you're just starting out and have a longer time horizon. You might lean more heavily into stocks, which historically have, higher growth potential, but also more volatility. Or maybe you're closer to retirement and want to prioritize preserving capital. Bonds might be a better fit for you there, offering more stability but potentially lower returns. Now, here's another key strategy. Focus on the long game. Investing isn't a get-rich-quick scheme. It's about building wealth steadily over time. Don't let those, day-to-day market swings distract you from your long-term goals. Stay focused on your plan and try not to get caught up, chasing the latest hot stock or trend. Remember, slow and steady often wins the race.
And last, but certainly not least, do your own research. Don't just, blindly follow the crowd or trust any single source of information. Even me.
Read articles, listen to other podcasts, consult with, financial advisors if you need to. The more you understand about the markets, the better equipped you'll be to make those, informed decisions about your own investments. Remember, we're all on this investing journey together. And like any journey, there will be bumps along the way. But by staying informed, staying disciplined, and staying focused on your goals, you can navigate those challenges and ultimately reach your destination. So is the party over for U.S. stocks? Well, maybe. Maybe not. No one can say for sure. But by understanding the potential risks and rewards and making, smart, informed decisions, you can position yourself to succeed no matter what the market throws your way. And hey, even if this particular market party does wind down at some point, there will always be like new opportunities popping up, right? New trends to explore, new ways to grow your wealth. The key is to stay curious, keep learning, and maybe most importantly, keep investing in yourself. Knowledge is power, especially when it comes to your finances. So to wrap things up,
should you be hitting the panic button and selling everything? Absolutely not. Should you be throwing caution to the wind and going all in on U.S. stocks? Probably not that either. Instead, take a deep breath. Look at your own, financial goals and remember what we've talked about today. Diversification, patience, and doing your own research. Those are your superpowers in this investing game. Thanks for joining me on this deep dive. I hope you found it helpful. And until next time, keep learning, keep investing, and remember, the best investment you can make is in yourself.